Hey there, Iggy the Investing Iguana here, and welcome to another exciting episode of The Investing Iguana. Today, we're diving deep into the world of gold and its jaw-dropping performance in 2024. Now, let me tell you, gold has been stealing the spotlight lately. It's been hitting record highs, outshining even the mighty S&P 500 year to date. Can you believe it? Gold is currently trading at a staggering $2,522.59 per troy ounce as of August 20, 2024. That's right, folks, this glittering metal is on fire. But what's driving this gold rush? Well, it all boils down to the big players in the game, the central banks. They've been on a gold buying spree, snatching up the precious metal faster than a lizard catching flies. In fact, central banks have been net buyers of gold for 8 consecutive months, according to the World Gold Council. The Central Bank of Turkey, the People's Bank of China, and the Reserve Bank of India are among the top buyers, each adding significant amounts to their gold reserves. Even retail giants like Costco and Walmart are jumping on the bandwagon, offering physical gold bars to the public. It's like everyone wants a piece of this shiny pie. But why are central banks so eager to get their hands on gold? It's all about hedging against the mighty US dollar. You see, gold and the dollar have a history of moving in opposite directions. With an anticipated US rate cut in 2024, central banks are betting big on gold to offset any potential devaluation of the dollar. Now, the million-dollar question: can this gold rally keep on shining? Well, I'll be honest with you, I didn't see gold outperforming the S&P 500 this year. But when we look at gold's historical price movements since 2020, it's been chugging along steadily, trading within its 90-day simple moving average range. Sure, there have been some healthy corrections along the way, but prices keep edging up. However, with the crucial FOMC meeting and Fed Chair Powell's speech just around the corner, anything can happen. Will there be a sell on news effect when the Fed finally cuts rates? Your guess is as good as mine, folks. But let's talk about how you can get in on this gold action. There are plenty of ways to invest in gold these days. You can go the traditional route and buy physical gold in the form of coins, bars, or jewelry. Just keep in mind that spot rates may not be the sharpest, and there's a markup for jewelry. If you don't want the hassle of storing physical gold, banks like UOB and CIMB in Singapore offer gold savings plans. This way, you can gain exposure to gold in your portfolio without the need for a treasure chest. For those who prefer a more hands-off approach, gold ETFs are the way to go. Major players like SPDR Gold Shares, iShares Gold Trust, and SPDR Gold Mini Shares Trust offer lower fees and eliminate the need for a bank as a middleman. And let's not forget about investing in gold-related companies. Some of the big names include Newmont Corporation, Agnico Eagle Mines Limited, and Barrick Gold Corporation. Closer to home, Singapore investors can check out CNMC Goldmine Holdings Limited or Moneymax Financial Services Limited, while our Malaysian friends have options like Po Kong Holdings BHD, Tomai Consolidated BHD, or Bavist Resources BHD on Bursa Malaysia. Now, I know what you might be thinking. Iggy, what's your take on gold versus stocks? Well, I'll give it to you straight. I'm a bit skeptical when it comes to valuing assets based purely on perceived value. Gold's value is influenced by a whole bunch of moving parts, which can be complicated. On the other hand, company earnings are often more straightforward to assess. Personally, I find it challenging to bet on gold's short or long-term movements, even though I know how and where to invest in it. I'm more of a fan of the higher certainty and compounding power of equities. Sure, gold may have beaten the equity markets year to date, but if we zoom out and look at a 10-year horizon, gold's appreciation pales in comparison to the S&P 500's gains. I mean, a 263% return versus 105%? I know which one I'd choose. But hey, different strokes for different folks, right? For traders, gold presents a strong trading opportunity. And for the gold lovers out there, this metal will likely continue to appreciate in the long run due to the simple dynamics of supply and demand for a finite resource. But for serious pure-play equity investors like myself, we're still better off sticking with stocks. Now, before we wrap up, let's take a quick look at what the analysts are saying about gold's future performance. According to the World Bank, the average price of gold in 2024 is expected to be $2,100 per ounce. Goldman Sachs is even more bullish, forecasting an average price of $2,133. However, ABN AMRO is a bit more conservative, predicting an average of $2,000 per ounce. So, there you have it, folks. Gold's record-breaking performance has been the talk of the town in 2024. While it's important to consider the long-term perspective and weigh your investment options carefully, there's no denying that gold has been shining bright this year. As always, I encourage you to do your own research and consult with a financial advisor before making any investment decisions. And if you found this video informative and engaging, don't forget to give it a thumbs up and subscribe to the Investing Iguana channel for more content on stock analysis, financial planning, CPF schemes, and money matters related to Singapore and the region. Thank you for watching, and until next time, this is Iggy, your friendly neighborhood financial analyst, signing off.